We just saw the largest LBO ever, Electronic Arts, taken private in a $55 billion deal led by Silver Lake, Saudi Arabia's PIF, which is their sovereign wealth fund, and Affinity Partners, which is Jared Kushner's private equity firm. Now, the last time we saw something like this, it was in 2007, literally the year before the global financial crisis, where we had TXU, a $45 billion LBO led by KKR, TPG, and Goldman Sachs Capital Partners. Now, it also resulted in a bankruptcy. So you might be asking yourself, is there something different this time? And the answer is actually yes. So the first big change is the equity check. So in 2007, the TXU buyers put up about $8 billion, or less than 20% of the total deal size, as equity. The rest of the deal was funded with debt. So when energy prices collapsed, that leverage obviously wiped them out. Fast forward to today. EA's buyers are putting up about $36 billion in equity, or around 65% of the total value, which is more than triple TXU's percentage and is a massive amount for a leverage buyout in general. Now, back in 2007, you typically saw that private equity firms often actually stayed away from tech companies because valuation multiples are too high. And this just boils down to simple math. So private equity firms don't usually like to put in, say, more than 30% equity. And so if you have a company that's trading at 20 times EBITDA, which is what EA was sold for, and the banks will only lend, say, at 7 to 8 times, the math just doesn't work. However, things have clearly changed. So EA is a tech company, right? Valuations are much higher. But Silver Lake does have a track record here. They actually did the leverage buyout of Dell back in 2013, which has turned out to be a huge success. In terms of leverage levels, EA's deal sits around 7.5 times EBITDA versus TXU's 8.5 times. So it's not really that much different. However, the massive equity cushion basically gives the company, or the banks, I should say, more breathing room. So if something goes south, it's the equity investors who are taking that first hit, not the lenders. But here's the wild part. JP Morgan is underwriting the entire $20 billion debt package by itself. That is a massive shift away from how these deals used to work. And so follow us for part 2. We're going to break down what that actually means because, spoiler, it actually doesn't mean that JP Morgan is lending $20 billion off their books. So we are going to get into a deep dive on what it means to actually underwrite the debt in the next video.